This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 494 was produced on August 21st, 2025. I'm Eric Townsend. Rabobank's Micheal Every returns as this week's feature interview guest. We'll discuss everything from what Trump and Bessent are really trying to achieve, to prospective next Fed chairs, to U.S.-European Union relations, to precious metals, and much more.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, August 20th, 2025. The S&P 500 index down 108 basis points, trading at 63.96. While the bull trend remains intact, we are starting to see some exhaustion in the price action. We'll take a closer look at that chart and the key technical levels to watch in the postgame segment. The U.S. dollar index up 44 basis points, trading at 98.22. Definitely has found its new fair value zone. The October WTI crude oil contract up 10 basis points, trading at 62.71. The downtrend is intact, but the puzzle to solve is, will we see a short-term drop back below the $60 level in the weeks to come? The October RBOB gasoline up 262 basis points to 196. The December gold contract down 59 basis points, trading at 33.88. A 4-month trade range continues to contain all of the price action. The September copper contract down 133 basis points to 444. The uranium up 97 basis points, trading at 73.20. And the U.S. 10-year Treasury yield up 5 basis points, trading at 429. The key news to watch this week is Friday's speech by Fed Chair Powell at the Jackson Hole Symposium. And next week, we have the U.S. preliminary GDP, the core PCE price index, and the much-anticipated NVIDIA earnings. This week's feature interview guest is Rabobank's Micheal Every. Eric and Micheal discussed the Trump-Putin summit, what a deal could economically mean, Fed policy, oil markets, and more. Eric's interview with Micheal Every is coming up as MacroVoices continues, right here at macrovoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Micheal Every, global strategist in economics and markets for Rabobank. Micheal, it's been a while since we had you on. Obviously, the really big topic this week is going to be the Trump summit with Putin. Now, we should let our listeners know we're actually recording on Sunday evening U.S. time, so it's just after the wrap-up of that session. Our listeners are going to have 3 or 4 days of news flow that we don't have yet in terms of what's happened afterwards. So I hate to put you on the spot, but based on what we know now, immediately after the wrap-up of these sessions, we don't even have all the news flow out. What's your take on the big picture of where this is headed? Are we about to wrap up and maybe wind down this Ukraine war, or is this just President Trump kind of, as he puts it, weaving his deals and maybe not really expecting anything to happen quite yet?
In this job, you and I are both paid to try and look well beyond 3, 4, or 5 days. So yes, there is going to be news flow between what we're recording now and when people will hear it. But hopefully what we have to say still has value over that particular, time gap. The view that I have is that it's likely to be not the end of the war per se, but the end of a phase of the war. And we could address it as a pause to refresh. And then the issue is, who is it refreshing? Because obviously we all want a cessation of the terrible violence. President Trump does. Russia certainly does, in terms of the fact that its economy is struggling at the moment and it needs that breather. Ukraine is being ground down. Everybody benefits from the fighting pausing. But where we go afterwards is a very, very different question. And I think there are multiple scenarios, but the most likely ones, which we can unpack, are that I think it's probably good for the US on balance. It may be a disaster for Ukraine, or it could be very good for Ukraine. And it could be very, very bad for Europe, or extremely difficult for Europe, but something that it emerges stronger from in the end.
That's a lot to unpack, isn't it? There's a whole bunch of things that could go one way or the other way, depending. So we better dive into the depending on what.
Basically, I've been saying for a long time that Trump would attempt to introduce what I've been calling a Noxin strategy, which is a reverse Nixon. Because in foreign policy circles, they've been talking about a reverse Nixon. I said, well, Noxin, that's a Noxin, where you try and make nice with Moscow in order to peel them away from Beijing, which is, of course, what Nixon managed to do with Beijing vis-a-vis Moscow, albeit after they had already had a spat. And here, the two haven't had a spat yet. So that makes geostrategic sense, except, of course, that Moscow and Beijing are currently very, very tight. And so I've also been making the quip for many months that Noxin wouldn't work because it starts with no and it's got Xi in the middle of it, Xi. So that still remains the underlying assumption. But that doesn't mean that Trump can't manage to patch things up with Russia to a certain extent by taking themselves out of the Ukraine loop and giving them some breathing space on that, both Russia and Ukraine. So I think what we'll see at the summit between the UK, EU leaders, President Zelensky of Ukraine and Trump on Monday in DC, and it's Monday here in Asia as I'm speaking to you, is Trump basically saying, look, the deal is going to be this. The land that Russia has already taken is going to remain in Russia. Ukraine cannot get that back, realistically. Certainly not Crimea. And realistically, most of the other territory too is now effectively Russia. So the greater likelihood is that the border is drawn along the river Dnieper. And then there are questions over certain pockets like Donetsk Oblast, for example, which Russia doesn't control all of. And Ukraine would say, well, why do we have to give up all of that particular province when Russia only controls half of it, et cetera, et cetera. So there are a few questions of where the line draws, but pretty much it's going to be around 20% of Ukraine is going to become Russian at this point, which is a victory for Russia. But for those expecting the US to say, well, we'll fight Russia absolutely to get that back, which Europe has been very vocal about too. Clearly that isn't in the US grand macro strategy interest. They want to pivot to Asia rather than fighting Russia over Ukraine, which is of marginal concern for them strategically. So that's not going to happen. And for those who say, well, the US and Europe together should be sanctioning the hell out of Russia and putting secondary sanctions on everybody else who deals with Russia, such that Russia has to surrender, well, they have to understand that means putting secondary sanctions on China, which means if you think you have an issue with tariff inflation coming ahead in the US, it'll be enormous because you would have to basically lock China out of the global economy straight away to punish them for dealing with Russia. And if anybody wanted to do that, they could have done that for the past couple of years. Nobody wants to. They're too integrated. The pain would be too great. So those sanctions are simply not going to happen. I'm not saying whether this is a good thing or a bad thing. I'm just describing it. And the US isn't going to step up militarily. So then Ukraine is going to turn around and say, well, we need a security guarantee. We can't just sit here and give up 20% of our land for peace with Russia, because Russia can then use that pause to rearm, which it certainly will, and will come back and nibble again and again and again and start taking more and more and gradually eat us whole. So then what's the security guarantee? What's that going to look like? And here, I think the US is going to say, Europe, over to you. We will sell you as many weapons as you need to defend Ukraine. So that's good for the US military industrial complex. That helps Europe also build up its own factories again, which are really struggling at the moment, but very much as part of US-focused, Pentagon-focused supply chains. So that kills any hope of European strategic autonomy. Europe becomes a subset of the US from an industrial perspective. And at the same time, the US is already leaning on Europe and others as part of trade deals and saying, we expect you to invest hundreds of billions of dollars in factories in the US, which, surprise, surprise, will be making inputs or directly those weapons which it sells to Europe. It's what some, including myself, are calling a reverse Marshall Plan, where Europe is helping to rebuild the US rather than the US rebuilding Europe after World War II. Now the roles are reversed. So if that happens, then effectively the US can pivot to Asia. It's selling lots of weapons to Europe. Europe is really kind of subsumed into the US economy. It has to invest in the US and it has to buy from the US. The US is in a better position, and I think we'll discuss this shortly, to roll out stable coins, and Europe won't be able to say no. because its economy and its security framework is based on the US, so it can't reject them. Hopefully, Europe then says, well, with that backing, we are prepared to put troops on the ground in Ukraine and ensure that the 80% of Ukraine remains, a buffer state between Europe and Russia, but it remains perfectly safe and viable as an entity. And if it does that, Ukraine may not, have a future in Europe in the immediate future or in NATO, but it could certainly exist. If Europe doesn't do that, if they can't agree who's going to decide, who's going to pay, how they're going to pay, and who's going to fight, because that's very much on the cards now, or at least in principle who would fight, then who is going to defend Ukraine? And then really you see that 20% of Ukraine becomes a 20% peace in our time, if you think back to Neville Chamberlain. And it may mean only 20% peace, PACE, in our time, which is an extremely worrying backdrop. So I've tried to give a very brief summary there, lots to unpack, but there are huge implications for lots of different markets and for geopolitics as part of that.
What I found most fascinating was you used the phrase pivot to Asia, talking about where the U.S. may redirect some of its military might. It seems to me like really the Iran and Gaza conflict is going to acquire more U.S. attention than China will, at least initially. Am I reading that differently than you are? Or how do you see Gaza and Iran fitting into the chronology of all of this as the U.S. pivots toward Asia?
Well, remember, the Middle East is part of Asia. Technically, it's Western Asia. We often tend to overlook that. What we've already seen play out in the Middle East vis-a-vis Iran, and what continues to play out in Gaza, is the US attempting to put down a very strong footprint as minimally as possible from its own side, in that it doesn't want boots on the ground. It doesn't want any repeat of the two Gulf Wars. But nonetheless, ensuring that oil-rich, energy-rich region stays very much in its pocket, not in Russia's and not in China's. And that is critical in order to gradually advancing towards China. And I would say, again, just as what the US may be about to do today, my time, tomorrow your time as we're recording, vis-a-vis Ukraine, which is going to upset a lot of people, particularly in Europe, but what I think is geostrategically advantageous for the US overall. And I'm not saying that as a moral judgment. I'm just saying that, objectively looking down helicopter view from above. They've achieved the same thing in the Middle East. Because while, again, they may be very unpopular in terms of what's transpired recently, the actions vis-a-vis Iran demonstrated to Beijing and to Moscow that when push comes to shove, even if the US doesn't want a major war, as Russia is currently carrying out in Ukraine, it is prepared to use enormous targeted force to get what it wants. Iran was strutting around, a few months ago as part of an alliance with China, with Russia, with North Korea, and trying to expand regionally via its proxies. It's really been put back in its box. I mean, it's rocking on its heels. And in fact, if you read the Middle East news, you'll see that at the moment, Iran is close to running out of drinking water. Completely. And I'm not exaggerating. They really are running out of water. So on that basis, what Trump did in striking Iran's nuclear program helps to lay a footprint which says to the Middle East, look, we're still here to stay, and we expect you to be in our camp fully, except Iran, of course, but Iran's going to be in that box. When push comes to shove, if push comes to shove, oil is going to remain priced in US dollars, and we're not going to let China make any further inroads there. So I think people have failed to join the dots on what's already been achieved there. And Gaza still grinds on. It's a horrible, horrible process. Once that eventually is resolved, and hopefully very soon, then I do think you will see a regional realignment politically, which will further back that US footprint.
Now, meanwhile, as all of this geopolitical stuff is going on, in parallel with that, we've got essentially musical Fed chairs where we're having a very public and visible process talking about who might be the replacement for Jay Powell. At the same time, Steve Bessent seems to want 150 to 175 basis points of cuts on Fed funds. And I get the impression that somebody has an idea to essentially re-architect the petrodollar dollar recycling system as a stablecoin recycling system. How do we integrate those things? It seems like there's this economic agenda that the president and Secretary Bessent are working at the same time as this big geopolitical agenda. How do we reconcile those two things and figure out what the market does in between?
Great question. Let me try and unpack that like this. First of all, I have to rewind back to something we spoke about last time I was on your show, which is we can't look at any one policy area in markets or geopolitics separately. We have to see all of them now as interlinked because we have left the previous world of economic policy, where you talk about monetary policy, fiscal policy, foreign policy, and we've entered the world of economic, military, and political statecraft, where the economy, the military, and of course politics are all integrated together, and every element of the economy is integrated together to try and achieve key strategic national security and foreign policy goals. So what I was just describing in terms of how the Middle East fits in with what's going on in Ukraine vis-a-vis targeting China, and I think many people can probably join those dots once I've put them on the page the way I just did. You have to understand too that the larger question that's always asked there is, what is GDP for? And clearly in the US case, it's to make sure that we stay number one and China is a long way behind relative to us and we stay global hegemon. That's what GDP is for. So if we accept that, what's the Fed for? Well, I can assure you it's not about 2% CPI and it's not about purely maintaining, financial market stability. It's not about maintaining a certain level of unemployment. It's not even about maintaining, moderate borrowing costs longer term, which actually is part of its remit and people tend to overlook. It's far more concretely about helping the US achieve that particular goal. Now, if you're a market purist, you can say, well, the best way to do that is to keep CPI at 2% and low unemployment. And I would say rubbish, absolute rubbish. It may be a subset in certain fair weather, but your central bank, with the enormous power that it provides, has to be cognizant of what the US grand macro strategy is and has to work alongside the Treasury and the White House. It's quite insane to imagine that you're implementing a grand macro strategy similar to a wartime footing and the central bank saying, well, we're not part of this. We're just going to look at 2% inflation. It's quite frankly ludicrous when you describe it like that. So very clearly, we have pressure being put on the Fed in terms of the floated appointment of the next Fed chair many, many months before Powell is due to step down. And even some of the names being floated as current FOMC members, which would be incredibly awkward. Imagine you're sitting alongside Powell in a meeting knowing you're going to replace him in 9 or 10 months. I mean, what's that going to do for the dynamic? But this is all being done not just to pressure interest rates lower, which is clearly something that the US needs to do to keep paying its bills easily. So, that is a subset of it. I think most people in markets can understand that. But more broadly, to get someone sitting there who understands all the tools they have available to them, such as Fed swap lines, for example, and realizing that they can be used very effectively as a weapon. And at the moment, the Fed doesn't do that. And I'm strongly of the view that at some point soon, it will start to do that. Now, let's go to the second part. I apologize, I'm going on a long time here. The stablecoins issue. You mentioned the petrodollar. Now, of course, that doesn't really exist anymore. It's been replaced by the eurodollar, which is just the broader international usage of fiat dollars everywhere. And the key point there is that offshore parties lend dollars to each other. They lend them into existence, and you create a huge pile of offshore liabilities for the dollar. Well, only the actual US has the ability to create those real dollars. So you have anywhere like, no one knows exactly, but it could be 120 trillion of offshore liabilities in dollars. And actually, you only have around 7 trillion in FX reserves abroad. It's a terrifying ratio. And of course, the US via the Fed and the Treasury can, step up and pump liquidity in whenever they need to. But they're the only ones who can do that. Everyone else can rehypothecate. But the only actual dollars they've got are those 7 trillion, and half of them are in China and can't be touched. So that's already a powerful weapon. But the quid pro quo for that is that the rest of the world gets to create those dollars. And in creating them, part and parcel of that process very often is earning them from the US via trade. And that has absolutely, even though you'll have a long list of other people on this podcast saying it isn't true. It is. That has helped to deindustrialize the US. Because when the US runs large trade deficits, which are a quid pro quo for the fact that everyone internationally needs and demands these dollars, that sucks jobs and industry out of the US. It's not the first country to experience it. It won't be the last. But it's an exorbitant privilege which comes at a cost. And right now that cost means it can't actually produce enough military hardware on scale to maintain the top dog military position that it's used to having. For example, you've got a magnificent navy, but you are going to be retiring ships far faster than you can build them at the moment. So the long run horizon for US military power doesn't look good vis-a-vis others if we carry on the path we're on now. Okay, so now we get to stablecoins. What are stablecoins? I was a skeptic of them for the longest time, as I was most things crypto, because I couldn't see what the point of them was. I understood what they were doing, but I couldn't understand why they were doing it. Well, if you're now going to create a legal framework, which you have with the Genius Act, whereby US dollar stablecoins must be backed one-to-one by T-bills, you are creating a demand for both T-bills at a time when the US is funding itself more and more at the short end of the curve, and a demand for stablecoins one-to-one. So they both feed each other. Now, it's good for the US front end of the curve, as I said, so that's good for its fiscal framework, even if it would look very dodgy anywhere else. But it also means that stablecoins can start to be used in international trade. The US could, quite literally, at some point soon, turn around and say, right, when you sell to the US, we are only going to transfer to you a stablecoin rather than the US dollar. And the US could lean on Saudi Arabia and the UAE, who are now much more in its pocket again after having bombed Iran, and say, we want you to tell everyone who buys oil globally, they have to pay you in stablecoins. Bingo, you've just managed to recreate demand for stablecoins internationally the way there's demand for the dollar now. And how does that benefit the US? Well, one for one, you have to start getting demand for T-bills while you do it. And alongside the tariffs that the US has got and the promises of inward investment from all the countries who are in the new trade deals it's put together, you gradually start to build those countries and those economies into a US dollar or a US stablecoin block. Because people at home or even private businesses in Europe, around the world, will start having stablecoins on their phone in an app outside the banking system. So you can absolutely not de-dollarize, as people are talking about, you can re-dollarize. And the great joy of stablecoins, above and beyond the fact that I said that they're one-to-one with T-bills, is you can turn them on and turn them off. You get to control the on-off ramp for them. So effectively, you have created a walled compound within which your allies are forced to effectively dollarize and become part of your supply chain and value chain, which helps reindustrialize you to help keep you top dog militarily. So it's a pretty clever package if you see all of it together, but you are going to need a Fed chair who understands how to play that game.
I'm going to push back a little bit on this because I see it a little differently, which is I agree with you that in the short run, stable coins clearly, especially with the Genius Act legislation, are one-to-one creating that demand for U.S. dollars. So, replacing the petrodollar system, if you want to think of it that way, we've got the U.S. dollar demand. But longer term, it seems to me what you're also doing is you're training all the central bankers and other holders of reserve assets around the world about stablecoins and how to use them. Once you've done that, it's so easy to just switch out of your US dollar-backed stablecoin into a BRICS buck stablecoin or some other stablecoin that's tied to some other currency. So I see it as creating an off-ramp further down the road to make it very easy to get out of the one stablecoin into a different one if there's a competitor. So, I look at this as, why is there no replacement for the US dollar? Because there's no viable alternative. And I think we're creating one.
It's a good point. But let me push back on your backing, if I may, in that part and parcel of what I think the US will be doing via this is trying to create the largest network effect as quickly as possible. And as we know from anything tech related as well as finance, once you've got that network effect, it really matters. It will be very hard, without Chinese-style firewalls for countries all around the world to prevent people just having US dollar stablecoins on an app in their pocket. So countries that previously would never allow the dollar to circulate could effectively dollarize. But I do think very specifically, number one, the US is aiming to use this for allies only. I actually don't think they want geopolitical rivals using this. They don't mind trying to maybe undermine them and have it in private sector pockets, but they don't want the governments having anything to do with it or having any kind of official role. So I do think it is deliberately leaning towards a bifurcation. That's part of the strategy, to make sure that there are US-centric, US stable supply chains and value chains and the other, and we don't go near the other. And secondly, while the BRICS can talk about it, and the technology isn't that hard. I mean, they're a very technologically capable bloc, if you look at India and China in particular. Putting it together so it works on the ground, so that you actually have a coherent economic bloc where supply matches demand, where you have upstream and downstream demand, and where you don't have some countries running vast surpluses and everyone else running vast deficits. Because the US will be attempting to narrow its trade deficit by doing this, so that its allies run more balanced trade with it. So it's a more balanced US-centric bloc. The power is with the US, but not via running deficits the way it is now. I don't see how the BRICS can replicate that. I've made that argument in detail for many years. If you do a very boring trade breakdown of who exports and imports what to whom within the BRICS, it's a very simple story. Nearly all of them are major commodity producers. China buys the commodities, makes everything else, and sells them to everyone else. Now, on one level, you can call that hub and spokes, but it isn't good for India, an eye within the BRICS. It doesn't help anybody else industrialize. And it means everyone else runs balance of payments deficits over time. So it's one thing to say the BRICS can adopt it. Sure. It's another thing to actually do that on the ground. And even if it did, as I started my argument here by saying, the US wouldn't be unhappy with that, provided they get the lion's share of all the countries that they want by hook or by crook. That's the kind of bifurcation I think they're perfectly willing to live with.
Now, Michael, you've described this concept of a grand macro plan that sits behind the various day-to-day events in the macroeconomy. Is Steve Bessent architecting a grand digital asset plan which incorporates stable coins and a strategic Bitcoin reserve and a Fed chair who understands this stuff and a bunch of other things, all as part of some concerted strategy that comes together towards some unified goal? I'm starting to get a feeling there's more to this than just President Trump's son is interested in Bitcoin. It seems like it's getting bigger than that pretty quickly.
Well, I've given you two very long answers, so now I'll give you a short one. Yes.
Okay, Michael, that's fair enough. Let's move on to another topic that I think you'll have a little bit longer answer for, which is, okay, look, European Union and United States, really since the end of World War II, that relationship has been pretty darn tight through thick and thin. Is it winding down and ending? Is it changing in a permanent way? It feels like, at least in my lifetime, relations between the U.S. and Europe are not looking really comfortable.
They're certainly not. If we actually go through the history of it, we've had repeated episodes like this. I vividly remember the whole episode with freedom fries rather than French fries, silly things like that. So we've been here before, but maybe not to this extreme. And the ironic thing is, everything that Trump has told Europe to do, stand up, spend 5% of GDP on defense, stop only exporting to us, buy things more from us, narrow that trade imbalance, are things that every previous US president, all the way back to Kennedy, had been saying too. And yet they didn't happen for decades and decades and decades. Now, I'm not trying to praise Trump. I'm just saying that's objectively true. And Europe is now reacting to it. Now, they're bitterly resentful and very unhappy, but they are finally pivoting under pressure. Now, from the European side, there is much talk, and frankly, Europe does specialize in rhetoric, much talk about the fact that they're going to try and strike out and achieve strategic autonomy. Now, the shopping list for that is very long. The bill is absolutely exorbitant, and I've always said the possibility of achieving it was like walking a razor's edge. You could do it, but incredibly hard to do, and it's a very dangerous fall either side. And if we look at what's likely to transpire in Ukraine today, or vis-a-vis Ukraine, I'm sorry. And if we look at the backdrop vis-a-vis stablecoins, which is really accelerating quickly, I think the shopping list and the shopping bill for Europe to achieve strategic autonomy is now ridiculous. I don't see it as realistic anymore. So while Europe may be sullen and angry and resentful, I think that ironically the relations between the US and Europe will grow tighter, but not as equals. Europe will absolutely be subsumed into a greater US production system, and as effectively the lieutenant responsible for guarding Europe within a US security umbrella. And they won't like that. They'll continually to be chiding about it, and that's completely natural. But I don't really think they have many realistic alternatives at this point. To put it specifically, I sat through many angry conversations with Europeans telling me that they absolutely would not spend 5% of GDP on defense, on NATO. Well, they all are, except for Spain and I think maybe Luxembourg, maybe Belgium too. Mostly they are. And then Europe absolutely telling me again and again and again, we will not sign an unfair trade deal. We're just not going to do it. Well, they did. We can be given the next set of we are not going to do X, Y, Z in instructions. And the realpolitik tells me that, yes, they will.
Now, meanwhile, the Financial Times, I think, used the phrase inflation nutter to explain who they feared might be put into the Fed position next at the U.S. Federal Reserve. When the FT is talking about the prospective next Fed chair as an inflation nutter, kind of tells me that their editorial perspective may have become a little bit, reserved about their perspective on U.S. monetary policy. It feels to me like we're kind of in this, Europe is stuck, they have no choice but to cave, so they're going to cave, but they're not going to forget this, is kind of the feeling I'm getting. What could they do if they're going to not forget this to eventually act on it?
Nothing. Now, I'm being flippant, but we have to be realistic.
But I just want to clarify, are you disagreeing that they're really not going to like it, or are you just saying there's nothing they can do about it?
There's nothing they can do about it. No, they really don't like it. But listen, I am absolutely on board. I want all listeners to understand this. I'm on board with very valid criticisms that are pointed many of the things that the Trump White House is doing, offending recent norms. Okay, I completely get that. I've worked in markets for nearly 3 decades. I fully get it. What I don't get, and I always try and point out in equal measure, is the absolute hypocrisy of the people saying that, about not pointing out how equally ludicrous things have been done by many others that they didn't criticize at the time and are still being done by many others that they don't criticize too. We have a slew of central banks that are cutting interest rates right now when there's no sign whatsoever that core inflation is fully under control. When there's absolutely every sign that the macro environment that they're living in, particularly in terms of the need for rapid rearmament, is going to be inflationary, highly inflationary in some sectors. And yet interest rates come down. Now, you could say they just don't know what they're doing. Fair enough. That's very valid criticism, but I don't see that as headlines. I don't see the Financial Times saying this central bank doesn't know what it's doing. Or you could say that they're just preferring to look the other way and hoping somehow that by lowering interest rates, they can paper over all the cracks, and that everything I'm describing in terms of a grand macro strategy won't be necessary, and we can just carry on doing things the way we always have, which I rather flippantly refer to as because markets. Which, even as someone who's worked in markets, as I said, most of my life, and, having a markets discussion here, I still think is idiotic. The world is not about because markets. There are far larger battles at play, literally, at the moment, and markets come secondary to that. They don't determine the outcomes. So, that commentary, I just wanted to make that feedback on it. But there's nothing really that the rest of the West can do, because if they were going to do something about it, it would revolve around a massive structural change in their political economy. But they're net exporters, and they net export to the US. Fair enough. If they want to massively expand domestic demand so that they don't need to rely on exporting to America anymore, there you go. Now you can suddenly be more in control of your own destiny. If they decided to spend 3 or 4 percentage points of GDP on their military for the last 20 years rather than on social spending, I'm not making a value judgment, that's just what they did, they wouldn't be in a position to be begging America for help with NATO. They'd be standing on their own 2 feet. If they'd acted more strategically in terms of energy resources a long time back, like China did, wouldn't there be any kind of domestic energy shortages or energy price issues. So all those choices were available to them decades ago. They didn't make them. And now when you put that conflation of different issues and problems together on the plate and you say, right, you've got to digest all of this in order to really do something against America, it's almost impossible to conceive they're going to do it, because in order to win, they would have to get involved in a multidimensional spat with America, which would hurt them far more than just having their wings clipped, which is what's happening at the moment.
How should we interpret President Trump firing the head of the BLS? Obviously, his critics are saying, look, he didn't like the data, so he's, don't like the message, shoot the messenger, or castrate the messenger in public ceremony to make sure the next messenger knows better than to make that mistake. But wait a minute. I think you've pointed out in some of your writing, the BLS was pretty darn screwed up. Maybe firing the BLS head wasn't such a bad idea after all.
Yeah, well, look, again, in terms of commentary, I absolutely understand why the market is freaking out about the fact that the head of the BLS was fired and that we've got a new guy in who is not exactly a fan favorite, shall we say, within the statistics industry. Fair enough. And that certainly fits a certain profile of, banana republic style economy. But equally, as you were just alluding to my mind, when I'm talking to people who, work in markets, those who understand the BLS have been a banana republic style joke for a long time anyway, even with the best of intentions, sit in one camp, and they're the ones I prefer talking to. And everyone else who thinks that every piece of data you're getting from America is absolutely kosher, transparent, completely trustworthy, and absolutely captures what's really going on. I really don't have any time for them because they don't know what they're talking about. It's not been like that for the longest time. One very simple fact, and again, I'm not trying to be political here, but let's look at the payrolls report. We all know how important that is. Markets still revolve around it. I presume they probably always will unless they stop publishing it, which is what the new guy is threatening to do. But it's a joke. Payrolls is a joke as a number. You've got like a 9-digit US labor force, let's say 150, 160 million, something in that particular range. That's the official number anyway. You're talking about a monthly 3-digit change, and the market trades off of the derivative of that, which is normally a 2-digit differential from a 3-digit number based on a 9-digit number. This doesn't mean anything. It's a rounding error, and we're taking it as some kind of signal. They're constantly revising it. It's based on a births, deaths model where they assume jobs into creation. It's got a very, very low survey feedback right now, so they're having to impute or guess more and more. It doesn't capture structural changes in the economy. And most incredibly, of course, and again, I'm not trying to be political, but it's a widely accepted fact. Anywhere between 10 and 20 million people arrived in the US in the past 4 years who aren't officially in the statistics, but are somehow being captured. Or maybe they're not, in which case we're not even capturing 10 to 20 million people. Either way, it's a joke. So, but no one seemed to be prepared to say this. Month after month, traders all sit down, wait for that number to come out and trade off the back of it because it's what we do. It's just what we do because markets. It doesn't fit into a grand macro strategy. So I certainly hope we don't go the banana republic route, where every single month we get a great jobs figure and everything's wonderful. That would be a joke. But I certainly think what we have now is also a joke. And it would really behoove both America and the rest of the world and everyone to have really good real-time economic information that we could use to try and understand where our strong points are and where our weak points are.
Let's try to assimilate everything that we've talked about into outlooks for markets. It seems like a lot of the things that we're discussing are related to geopolitical risk hedges, things like gold, Bitcoin, Ethereum, silver, and so forth. I've been trying to decide where some of those risk hedges are headed anyway, because on the one hand, you can make the argument if we're really maybe about to wind down the Ukraine war, that should be risk off for gold. It's a risk hedge. We should be unwinding it. But wait a minute. If what we're doing is winding down Ukraine so we can pivot to the next war in a bigger theater, that's not time to sell your hedges. So is this a bullish or bearish moment for precious metals and other hedges?
First of all, as you know, I don't give investment advice, so full caveat on that. We're just having a hypothetical discussion. I think you frame it very well in that when you see the word peace coming through, one's initial market reaction might be in one direction. But if you take a bigger picture view and understand that that's only part of resolving one issue, and actually, by the way, passing the buck to Europe and saying yours, so that you can then focus further east. And that the underlying pressures for a bifurcation of the global system, which is what I keep emphasizing here, are rising, then, it still makes a lot of sense to be looking at all kinds of hedges for all kinds of products in all kinds of ways. The very simplest kind of market call that you can see ahead is the Fed's going to be forced to cut rates, ergo everything goes up. Yeah, obviously there's some very simplistic validity to that, as if things haven't already gone up enormously anyway, which they have. But we are entering uncharted territory because nearly everyone who's working in markets now, and I think I made this point to you last time we spoke, just by dint of their age, has spent all of their working career in an environment in which it was a one world economy, one market. And sure, there were certain areas where you had to get in or get out of tactically. But the assumption was everything was fully integrated and it's just, where do I pick up yield? We're going to be heading to a world where certain sectors can't be traded or where returns are fixed by the government either at a high or a low level, usually low, and where certain environments are just completely, untouchable. I mean, for example, if you look at what's happened at Bridgewater recently, reading that particular headline and suddenly, reversing position on China, very belatedly, by the way, we can probably expect to see a lot more of that happening if we are moving towards a world in which one has to make geopolitical choices, which will be part and parcel of currency systems and clearing systems and payment systems. So if you're going to be within a US stablecoin system, maybe you don't get to be in other systems. And if you're in other systems, maybe, as I said, you don't get to be in stablecoins. Or if you do, it's via a VPN being naughty in the background rather than with any kind of government permission. And, will markets find a way? Sure, markets will find a way. But it's not going to be the same flat world structure where you've got a world map on your wall in most offices and you can put a pin in whichever part you like. It's going to be complicated. And one very clear example of that, just to wrap that point up, is previously, a few years ago, tariffs weren't an issue unless you were dealing with one particular complicated emerging market where you had a lot of paperwork to do. You didn't worry about what the tariff was. It was going to be so marginal you could ship from A to B. Have you seen the table of US tariff rates now? Like the exemptions and potential changes coming up and country by country, sector by sector. It's a telephone book. And that's absolutely deliberate. That's the strategy. Make it complex. Therefore, make people do things more locally. And where you are doing things more locally, money will eventually change hands more locally.
Michael, before we close, let's touch briefly on oil prices. We're on the low side, at least compared to the last year or two. Are we headed higher, as some people think? We got plenty of backwardation in the market, so I'm not sure what to make of this.
We have a really interesting standoff in terms of the go-to research on it, like the IEA versus OPEC Plus and what they're both printing. I think, again, no geologist whatsoever, so I'm not going to get into that side of it. You need to look at the geopolitical backdrop. Now, obviously, we had that spike earlier in the year around Iran, and of course, prices came way off once the US got in and got out and sent that message without getting sucked into a war. And I think we need to recognize that low energy prices are a key plank of the Trump grand macro strategy. How that's going to work out within the US energy sector, because obviously low prices mean people don't want to produce and Trump doesn't want to be importing. He wants America to be exporting, or at least producing, even if prices are low. That remains to be seen. There will have to be some jiggery-pokery to get that to work. I can assure you there will be. But the secular envelope is that Trump wants to see low energy prices because most upstream commodities to him, energy most so, but many others, are seen as inputs to more value-added production downstream. So in other words, let's get cheap inputs so we can make more cheap outputs and more of those outputs. It's no longer every sector of the economy from upstream to downstream being equal because markets. Some people now are just not as important as others. Some people are there basically to do the equivalent of serving you drinks for very low tips. And, that's unfair. It's not very nice. That's the way life is.
Well, Michael, I can't thank you enough for another terrific interview. But before I let you go, tell us a little bit more about what you do at Rabobank, how people can follow your work, and what your Twitter handles and so forth are.
Sure. As global strategist in economics and markets, my job is to think cross-asset, cross-geography, and cross-disciplinary, to be honest, to try and draw out what are the big picture themes. So it's not just about whether you're, long this or short that. That's not specifically what I do. It's to try and draw all the dots together to say what is actually happening And if you assume that's what's happening, logically, what would then flow on from it? So you're narrative building to an extent, rather than telling people how to manage money. But it's been a very, very successful strategy for the past couple of years. And not seeing the bigger picture has really been problematic. And I think it's going to be more and more important going forward, even if I'm talking my own book there. In terms of where you can follow me, I am on LinkedIn. For Rabobank clients, Rabobank Knowledge would be the place to go and check out, but you do need to be a client to get our good stuff there. And I enjoy conversations and interaction with people on these topics on X, and my handle is at the Micheal Every, Every, all one word. And yeah, please do just come and join that conversation, because I'm always keen to interact with others and to see what you're thinking. Because when you've got a global role, the more input you have, the more voices you have, the better your view of that picture becomes.
Patrick Ceresna and I will be back as MacroVoices continues right here at MacroVoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, it's great to have Micheal back on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Michael's picture saying, looking for the downloads.
Well, Patrick, it's starting to look like the S&P chart could finally be topping, maybe after hitting my target of 6,500, but we're already bouncing off that 34-day moving average. What are the charts telling you, Patrick? Is there more downside still to come?
Eric, what a great question. The short answer is yes, but it's about how and what form it's going to occur. What we witnessed here in the last week was a clear sector rotation. What we saw was the selling was predominantly focused in the technology space and the AI space, which was down over 3% over the past week. At the same time, that money was redistributed and started to rotate. We saw not only international strength in things like money flowing into the Nikkei or the Euro stock, but also in the defensive sectors. We saw a very strong push higher in the healthcare space, in consumer defensive names, and even in the energy space. And so there was money that was being essentially redistributed. Now imagine these big money managers that are now massively overweight these tech names just simply because they were where the rally was occurring in their portfolios. And in a very typical rebalancing and reweighting, they would sell down some of these positions and reallocate that to where there is more asymmetry in opportunities and definitely less volatility. And so we are definitely seeing that rotation. Now, NVIDIA's earnings is going to play a very pivotal role in this next week, because if NVIDIA in any way disappoints to trigger some distribution to continue, then we will see under the surface this rotation continue. Now, these Mag 7s and other big stocks are so huge to the S&P 500, even though this rotation will be getting underway, it would be generally a drag on the S&P 500. And it certainly would imply that we are likely continuing to see a bigger topping formation where we're going to see substantial overhead resistance and far more of a sideways consolidation. The best example was from November of last year through February of this year. There was about a 4-month period where the S&P 500 more or less remained within a several hundred S&P point range, trading more sideways. I think that is, at least for the next few weeks, likely. As we get into September and we get into the September jobs numbers and the first Fed rate cut, there's all sorts of room for volatility that may ensue going into the fourth quarter of the year. But right now, in the short term, while we may see the S&P weaken a little bit further, let's say down to 6,300, where its 50-day moving averages, I think the bigger theme is how this sector rotation is going to be occurring under the hood. All right, Eric, let's move on to that US dollar index. What are you thinking here?
Well, Patrick, my read of the chart is that we're settling into a horizontal consolidation that's centered around 98, even on the Dixie, plus or minus 2 big handles. So in other words, 96 to 100 is the trade range on the Dixie that I think we're settling into. Most of that happening between 97 and 99. We'll need to see a sustained move above 100 or below 96 to say that that consolidation has ended, and obviously that's a fairly wide range. My fundamental bias is still strongly dollar bearish relative to both other currencies and hard assets.
Yeah, well, Eric, in my view, the U.S. dollar has clearly found a fair value zone, and we certainly have started to see divergent action in a number of the different cross currencies. When the US dollar really starts trending in a meaningful way, we tend to see almost all of the cross currencies correlate and move together in either direction against that US dollar. Here we have a very mixed bag. While the euro and the pound sterling stayed clearly in trend, we see the CAD and the Japanese yen very much diverging and therefore making a big muddle, and overall no real conviction on it. It's very likely that some of these catalysts, such as the Jackson Hole and or potentially the first Fed rate cut in September, could wake up the currency markets. But at least at this juncture, the activity in the currency markets is very narrow, tight, trade range bound, pivoting right on its 50-day moving average, and no conviction of a move yet. At this stage, I think expecting the next few weeks to have more of this types of sideways price action and inactivity to continue in the dollar is certainly, in my opinion, the highest probability. There will be a bigger move, but very likely it's going to be pushed out into the fourth quarter of this year. Now, Eric, on page 4, I have that chart of the crude oil. What are your thoughts here?
Well, Patrick, so far the market seems to want to hold support on that 100-day moving average, which is 62.59 on the October WTI chart. So Wednesday gave us the closing print that technically suggests maybe the bottom's in now, but will it hold? Let's see what the market brings. If we can stay above 62.59, that 100-day moving average, then this recovery's got some legs to it. Maybe the bottom is in.
Well, Eric, I'm not overly bearish crude oil here, but it is in a primary downtrend and it's still being distributed. The vulnerabilities of it potentially having a trip to retest the April and May lows, something that cannot be ruled out. At some stage, I do believe that crude oil will bang out a bottom here, but it could probably be a story that takes the remainder of August and early into September in order for us to really establish that. At this stage, I remain neutral crude, but I actually do believe that there's going to be a compelling buying opportunity to come in the weeks and months to come, just looking for where a meaningful entry point will make sense. All right, Eric, let's move on to gold. What are your thoughts?
Well, Patrick, the correction we've just had made perfect sense. The market mood was peace for Ukraine, was at least coming into view on the horizon, if not almost at hand. So geopolitical hedges started to unwind. The slow stochastics and the RSI finally bottomed on Tuesday into Wednesday, and I think we may be on the cusp of a surge higher to new all-time highs in gold. I think we may have just seen that swing low that leads us into the next surge higher that hopefully breaks us above the previous 3,500 or just above 3,500 all-time high. Now, of course, anything's possible, but we've gone from extreme overbought on the slow stochastics to extreme oversold. And the setup for a breakout to new all-time highs is much better now than it was the last time the market tried but failed to break to new all-time highs. Better yet, we got from extreme overbought to extreme oversold on the slow stochastics without putting in a lower low on the price chart. So we shook off all of that overbought, got back to extreme oversold, and we're still showing a bullish setup in terms of the pattern of higher highs and higher lows, even after shaking off the overbought condition now into extreme oversold. So that leaves us with bottoming stochastic oscillators coincident with a nice solid recent pattern of higher highs and lows. I like that. I added to my gold longs on Wednesday accordingly. I'll cross my fingers and see what happens here.
Well, what is clear, Eric, is that gold has been in a sideways range-bound wedge for many months and has not yet shown the conviction of breaking to those 52-week new highs to drive that next bull impulse. At the same time, silver has stalled out. We've seen platinum and palladium also deepen consolidation. The only interesting observation to make here is that gold miners continue to take flows and they continue to show relative strength and continue to actually remain in trend. It'll be very interesting to see whether gold miners can bullishly continue to diverge from the trade range bound markets of the rest of the precious metals and continue to drive further new highs. Overall, at some stage, the bigger bull phase of another leg higher in gold will inevitably come. But at least at this moment, there isn't, to me, any of the technical signs that this is imminent. All right, Eric, let's talk about uranium and this current correction that we're seeing. What's your thoughts?
Well, all sorts of pundits are taking all sorts of different guesses, and I assure you they are all guesses, as to what's the proximal catalyst for the very sharp sell-off in uranium miners on Monday continuing into Tuesday. Well, the reason for the pullback is, drum roll please, because the market was overextended to the upside and needed a pullback, which experienced bulls will welcome as an opportunity to buy the dip. To my thinking, the most likely proximal catalyst to explain why it suddenly broke on Monday is peace expectations around Ukraine, spooking hot money that never bothered to learn uranium fundamentals in the first place to come to the wrong conclusion. What's going on is peace with Russia is actually bullish uranium, not bearish. We've explained why in past episodes. But the tourists don't know that. They hear that sanctions could be lifted, and they're just imagining those stinking Russians flooding the market with all their cheap uranium, those pinko commie bastards. Well, little reality check, folks. They don't have any significant uranium inventory to flood the market with. The market doesn't work that way. It's much more about conversion and enrichment capacity, and there's really no reason to think that the peace deal that's on the table would even result in ending the bipartisan Russian uranium import ban in the first place. So the whole logic doesn't make any sense, but the point is there's more of them than there are of us. There's a lot more hot money idiots that are selling hard right now because they don't understand the fundamentals. They're going to beat the price down. I hope we can get down to, let's say, below 34 on URA. I think that's probably coming, and I think it's a great buy range between 32 and 34 or so on the URA ETF. But you know, the longer-term bullish story couldn't possibly be stronger. This is the beginning of the long-awaited buyable dip. We need some kind of catalyst to bring it on. I'm guessing that catalyst is what I just explained about Ukraine war risk coming out of the system. Maybe that has nothing to do with it and it's something else. I don't know. There's a bunch of theories about it. One way or another, we're getting the long overdue correction. I still expect in late Q3 and Q4 that this market really takes off to the upside. So the question is, you know, if you're really good at buying dips, find the bottom. I'll definitely start buying URA at 34 and keep scaling in if it comes down from there.
Well, Eric, in my framework, every rally needs to be checked. And after such an epic bull run where we saw a doubling of uranium stocks between April to end of July, eventually was going to have some sort of a pause and reversion. Now, typically, when you have a very strong bull market and this type of a pullback, you always want to make the assumption that pullbacks are buys on dips. The bigger question is, will this be a full 50% retracement where something like the URA drops all the way down to the low 30s, or will this just be one of these quick corrections where we temporarily break below the 50-day like we currently are and almost immediately gets bought on dip? One way or another, we're in the midst of a correction that should offer the first compelling buy on dip opportunity that we've seen since the rally started back in April. So we'll see where it settles in. I would suspect and ideally want to see, let's say, the URA trading down to the $34, $35 level. And at least there you have some asymmetry, even if there is a few dollars of volatility around it, where we could be looking for the short-term buy on dip traders that can take this right back into the 40s on a potential advance. Now, Eric, copper has been relatively quiet here, just consolidating after that big tariff pop and drop. How do you continue to size this up?
Well, the lack of even a full-fledged dead cat bounce is frankly starting to concern me on this chart. The logical mean reversion retrace level on the HG chart was around $5. We're barely holding $4.50. I can't explain that. I don't see any other recession risk indicators that are telling me that there's an oncoming recession, and we absolutely positively do need lots and lots of copper to keep growing the global economy. So if the copper market is stagnating, that probably means somebody thinks the global economy is about to start stagnating, or this copper market needs to recover. Again, I think this did happen because of tariffs, but we ought to be seeing some recovery here, and I don't understand why we're not getting it. Finally, Patrick, before we wrap up this week's show, let's hit that 10-year Treasury note chart.
Well, Eric, I just wanted to wrap by just touching on that 10-year Treasury yield, which we continued to see lower highs, lower lows. Now we see a rejection at a basic moving average fib zone. And so we clearly have a yield that is weakening and a potential bond market that may run. Now, I'm not super bullish bonds, but I also think that if they weren't going to break down and yields blast off north of 5%, that we were inevitably work to the bottom end of the yield range, which is down near 3.5%. So are we about to see a trip down under 4% on the 10-year Treasury yield? It's entirely on the table, and certainly of some short-term safe haven in some bond holdings may be in store. What I particularly like about this, Eric, is that it's definitely a contrarian play. It's certainly out of consensus, and there's a lot of people that at this stage continue to not like bonds. And so typically some of the best moves happen when everyone is offside on these trades. And I don't think right now there's a lot of people looking at these bonds as an opportunity.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview, as well as the chart book we just discussed here in the postgame, including a link to a number of articles that we found interesting. You're going to find this and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main account on X at MacroVoices for all the most recent updates and releases. You can also follow Eric on X at Eric S. Townsend, or you can follow me at Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.